a bit of a limitation on how we might go about being able to reply. So if you are watching from YouTube, the best way for you to be able to do it is to simply post a comment as opposed to using the chat function or the live chat function, and I'll be able to actually look at it tomorrow. So bear in mind that if that is the case, do it through a comment. Don't do it through the chat function in YouTube because it is a little bit difficult for me to access. Now, moving on from that side of how to get in contact with me and the like, tonight's agenda, we're going to be looking at a few different things. I figured with the last bit of action that we've seen in the last 2 days, it's probably worth reviewing some of the recent events and the sentiment that's gone on just in the last 2 days. I'll probably include oil in that because we did get a bit of a shock on the movements that they were deciding to do on that front. And of course, tomorrow we have an RBA speech, so it was probably ideal to look at the Aussie dollar. So they're generally the focus points of tonight. Depending how many questions you guys have or how many charts you have, I can cut back on some of these to try and get to everyone. But please, if you do have a chart, let me know earlier in the piece so that I can sort of work my way into sort of managing that side of things. If I sort of get 5 at the very end, it gets a little bit chaotic. So to move on from this side of things, the next bits that we're going to be really dealing with is a risk disclosure warning. This warning here basically says that it is to be anything I say in this presentation tonight is to be considered as generalized advice because I can't offer you guys personal advice through this medium. And of course, if you are wondering about if you're getting into trading or thinking about getting into trading, it's important to understand what your investment objectives are, what your risk profile is, and of course, your general level of experience. If you're not sure on any of those 3, then I would recommend getting in contact with a professional to give you a bit of a hand. And of course, you're welcome to reach out to me and I will do my best to sort of serve you in the right directions that you need to go. Now, moving forward from this, getting rid of the risk disclosure warning and all the sort of boring stuff, we're going to go straight into some charts whilst I'm sort of having a look. There's a couple of things I want to sort of talk about today, and there's a little bit of a reason for the sentiment that we're all seeing at the moment. Now, to get started, the NASDAQ, the NAS 100 has come down a fairly significant amount. It's down about 11% from the very top. Just in the last 2 days, it's down about 2.9%, roughly 3% at the most. And the other weird one is that we're seeing the Dow Jones, which I'll just pull that up for us. That should be this one here. There we go. The Dow Jones is actually going in the opposite direction. So it's not very common for that sort of scenario to happen. The last time we saw some divergent behavior of this kind was back in about 1993. So there is a few different things that are going on behind it. We're going to get pretty in depth on the NAS and the Dow Jones to get started with and to have a look at a few different things. But we'll start off with the generalized sort of approach that I usually use. And so we've spoken about sentiment, and some of you might not know what sentiment is. Sentiment is generally how we feel about a market. Now, there are obviously much more in-depth explanations about it, but if you were to think of the few schools of thought about fundamental technical analysis and all those sort of things, under your technical belt, you would have the technical analysis, then you would have algorithmic trading, which is where you're being a little bit more specific, or you're coding programs, you're taking the exact same strategy every single time. In a technical strategy, you are comparing the time versus the price. And that's really all the data you get. We're really just looking at charting. When we go to the fundamental side, we have a few different circles of information. Now, I'm just going to use some shapes to sort of give this description because it sort of helps with understanding what sentiment actually is. Now, when we sort of, didn't like that. Now I'll use boxes because boxes always work for me. So instead of just pretend these are circles. Now, if we were to think of this circle, of that red circle I've just drawn, as the circle of information related to technical analysis, all the information we get inside this box relates to technical analysis. When we then go to the next step, which is the fundamental analysis side of things, the box gets much bigger. And that's because we're now dealing with macro data, we're dealing with politics, we're dealing with the technicals, we're also dealing with where we might be looking in terms of asset pricing, supply and demand. The box gets really, really big and really, really complicated quickly. Now, the biggest circle or box of information in this instance is looking at the next big one out here. And this box is what you consider to usually be something called insider trading. So, you don't get these opportunities much. And if you do, they're technically illegal. So we try to avoid them in most instances. Now, when we do think about this big box of information and the fundamental analysis, it includes a piece that might be just down here called sentiment. And sentiment really gauges on the intraday stuff. So if we were to think about fundamental analysis and the long-term objectives when we think about pricing on any particular asset, whether that be oil, whether that be the Dow Jones or a company, generally fundamental analysis does have a little bit of a longer timestamp to it. You might find that you're dealing with positions, a couple of positions a week and holding them for a couple of weeks. Whereas when you're dealing with sentiment, it's about the immediate emotion. So, that fear of missing out, that fear of getting out, all of those sort of factors apply to sentiment. And at the moment, sentiment has been pushing higher. And it's not really surprising. You've got indicators looking really, really positive in terms of economic data coming from countries. But I think that's likely to continue, but it's important to compare apples to apples. At the moment, the economy has come out of a massive hole. So naturally, all the data that we look at is going to be positive because it's going from literally negative data or zero to growth. And that makes it look really, really good. And it is really good. So don't get me wrong on that front. But the apple to the apple scenario would really be looking at the pre-pandemic growth of, before we went into lockdowns, before the world shut down, to the relative growth now. And in most instances, you will actually find that we are below what we were back then. Now, naturally, if we were to take it from the apple to the orange being the pandemic and the apple being right this second, it looks fantastic. But if we actually look at that other side, the apple to the apple, we are sitting or tracking below. In Australia's instance, I think it's about 3.5% below what we were pre-pandemic. And that's where we want to get to. That's where we actually start getting the economy really back on track, because we're getting back up to those levels of growth, those levels of development that were in effect beforehand. So when we don't, whilst I don't expect to see the same run of growth that we've had before the pandemic for several years, and we are currently tracking about 3.5% behind that target, there are still plenty of markets that are lagging behind. Corporate insolvencies. This is an interesting one. Now, I think I have a picture of this. I'm just going to have a quick look. No, I don't on me. Now, I was looking at some data a bit earlier today, and it was talking about corporate insolvencies. Now, last year, corporate insolvencies are actually half the normal rate. And that's because of all the forbearance measures that have been put in for stimulus and all those sort of things. So the normal amount of businesses that you actually would see close under normal conditions have remained open, particularly here in Australia with the likes of JobKeeper and all of that subsidies that have been coming from the government through stimulus. So that's given a little bit of concern to me, because as we start to see the Federal Reserve and the RBA and all of these other sort of, places trying to give a bit of a dovish stance at the moment, at some stage, we're also seeing from the fiscal side that they're starting to taper off some of those purchases and starting to increase taxes. The UK has already done it. We're starting to see signs that Europe may potentially do it. The US obviously isn't doing it right now, but it won't be far behind, I don't think. And Australia is certainly already tracking down on those JobKeeper sort of payments that are going on. So they'll be getting less and less and less, and eventually they will go entirely. Now, when that happens, expect to see there to be a number of corporate insolvencies and business insolvencies happening. So, but for the time being, we think about this RBA stuff that's going on as well for tomorrow. You can expect that they're probably going to maintain their resolve. We've still got yields, which I'll just bring up some yields for you guys to have a look at, which should be here. Yep, here we go. Now, here are our yields for today. They're actually a little bit, I might just refresh that, make sure it's all in the right direction. Now, yields across the globe, yields across the globe have been sort of moving at a pretty random sort of paces, almost it seems, but they are constantly moving up. So, although they work okay. Now, I definitely have seen yields in the US sitting at about the 1.6% range on a lot of their treasuries. Australia is a similar sort of position. Ours are actually at 1.77%. off the top of my head. And this is that inflation talk is what's been going on the last sort of 2 days. We've been seeing people a little bit concerned about, the Fed has said that they're not going to be doing anything. Don't worry about it. We look at the inflation side of things as optimism in the market, but is it really? Now, chances are a lot of them are starting to price in, and a lot of traders and investors are starting to price in the idea of tapering starting to happen early. Now, whilst I am an avid believer in the fact that we are unfortunately going to have to taper off some of the yields, some of the bond purchases, potentially increasing rates at some stage much further down the track, and that is likely going to happen sooner than what the estimates are or the projections are at this point in time, we still have inflation being very, very low. Wage growth is very, very low. They're both sub 1.5%. And ideally, realistically, before in the RBA's instance, and just thinking about tomorrow, when we hear from Governor Lowe in the morning, then realistically, they're going to want to see inflation sitting around 2.5% consistently, and they're going to want to see wage growth up near 4.5%. So we tend to see that inflation isn't. So, my God, I can't clear my throat. Sorry, guys. We tend to see inflation in asset prices is not so much consistent in it. It's not a broad approach. It doesn't come in every single area. And for us, consumer inflation tends to be the one that stays lapped. So that's the things that's coming from the retail sector, where we all go and spend our money. It could be a service station, it could be in toys, it could be in games, it could be in fuel and all those sort of things. So I feel, inflation is likely going to have these pops and eases over the next couple of months, maybe even the next few years. And I'm skeptical that we'll actually have long-term sustainability of it immediately. Where I do see that inflation will likely rise actually happens to be in asset prices, more generally speaking in commodities, particularly for here in Australia. And realistically, we will need to see GDP start to have consistent growth over the next few years. So the bigger issue is that market expectations aren't matching the narrative from central banks at the moment. And that's something that's very, very difficult to edit. So far, lots of people are associating the idea of growth with inflation. And while they do have a relationship, they're not necessarily in perfect sync. So at some stage, there is going to be all these changes. We are going to have to consider the impacts of them all. And now the factors that we are looking at today in terms of these issues that are sort of withstanding at the very moment is what I like to call a little bit of the great rotation. Now, we can see here between these two, the NAS 100 is down, whilst the Dow 30 is, made a new high in the last 2 days and is up near its high, within 1% of its all-time high. Now, whilst investors are feeling better about the economy and it's beginning to show in stock markets, I think this is one of the best examples. This comparison of the Dow Jones versus the NAS 100 gives us, a really good idea from Monday's trading action on how people are actually thinking. This is actually the first time in nearly 3 decades that there's been intraday divergence of this magnitude between both of these indexes. You've got one near an all-time high while the other is retreating away from it. So as the Dow Jones rallied to its, sort of next record and the NASDAQ slid to its correction, it's the first time, like literally in a very long time. It's a 125-year-old Dow Jones Industrial Index, 36-year-old tech gauge. And that is something that does really sort of sit on the back of my head. Now, out of the stocks that we did see on this front, 25 out of the 30-member index rose higher on the Monday. Walt Disney Co. shares were really pushing the way forward on the industrial index. And then while the NASDAQ, it was Apple and Tesla that got a little bit overweight and were pushing valuations down. Now, the fundamentals of both markets have had a considerable shift in 2021. More and more investors are basically becoming confident that the cycle is beginning anew. The difference in the activity of this rotation is really showing that people are moving away from that work from home environment and that mentality, and from in a mentally and a physically sort of way. This behavioral change is really beginning to sort of build into their fortunes as well. Any money that you sort of have, you're sort of thinking, okay, well, now that we're mentally just stepping away from the work from home environment and physically we're able to go back to the office and things are sort of starting getting a little bit better, we're now thinking that our money needs to be in different places. So it's presenting us with a hell of a lot more optimism, and that the economy is effectively going to continue to recover and grow. The more this happens, I think the more we're going to see a greater divergence between both the Dow Jones and the NAS 100. And realistically, the pain on those sort of high growth, high valuation tech shares is, in my mind, nowhere near over. They're becoming less and less appealing in the midst of what we're seeing with bond yield volatility at the moment. As the economic recovery, the vaccine delivery continues, and the bond yields keep rising, I think we're still going to be seeing, we're going to be seeing it move a little bit further away. Now, having said that, there is still hope for good technology companies. And yes, sort of, hi Al, my audio is breaking up. Hi Jason, I'm not sure, I've only just noticed your message, I'm afraid. Is the audio breaking up is anyone else, if anyone else in the webinar is able to hear me clearly, could you just, or not hear me clearly, I should say, would you mind just giving me a quick, yes, audio is fine message in the chat function, please? Because if you guys are having trouble hearing me, then that is certainly a problem. I'll give you guys a bit of a minute to sort of respond on that one, because that is a bit of a problem. Is it any better, Jason? Would you be able to let me know? I've not made any changes here. I'm just not quite sure why it's causing problems. I'm going to assume everything's all cool. No one seems to be letting me know that the audio is still playing up. If it does, just please chime in. I'll keep a much closer eye on that chat function so that I can see it. Now, where were we? Yes, okay. So the reason I think of markets, a lot of people sort of look at the idea of a bubble as being something bad for the economy. Naturally, it has its bad elements. But when we look at bubbles, there's good bubbles and there's bad bubbles. And bubbles, whilst they always usually carry the negative connotations, it's worse now. Geez. Is anyone else having the same sort of issue? I don't seem to be, I've got no problems on my end from what I can see. Are you able to, I'll try and unmute myself and I'll How about now? Is that better, Jason? Yes. Okay. I'm not sure. All I did was mute and unmute my microphone, so hopefully that fixes it for us. Now, when we think about bubbles in economies, we normally think of things like the dot-com bubble or the credit card bubble, and all of those have we always tend to focus on the disastrous implications of bubbles. But the fact of the matter is that innovative technologies come from bubble environments. No matter which way we look at it, after a bubble has finished, if you were to think of the bubble as being, one of these boxes, and this box is the bubble market, let's say it's the tech sector right now, in all of our markets right now. Now, what you end up finding happen in these sort of circumstances is you end up with a flow of money going just into this sector, even though there's 50 other sectors to choose from, all the money's going in here. And it happens in sort of 5 different stages. You have the early adopters who go, oh, this is a good opportunity. Then the media gets attention of it. Then we start getting people who have got a bit of fear, because they've heard about it in the media, they think, oh yeah, this is a great opportunity, and they jump in. Then it gets bigger again, and this bubble just keeps on going up and up and up and up and up. And by the 4th stage, you sort of start getting people moving out of that bubble. It's usually these guys here at the very start, the very first adopters, and then on the, by the 4th point, they're usually trying to exit. And by the 5th point, you kind of got the guys left holding the hot potato at the bad point. Now, whilst that's, there's someone that's going to lose in this instance, no matter what happened, and the bubble does eventually shrink, there's so much money in this market that they don't know what to do with. And if you think of a company and being innovative, they tend not to actually focus on some of the other areas. And think of it from this perspective. If you've got, you're a company and you have three different solutions to the same problem. One of those problems makes money now. One of those solutions makes money now. It's a viable product. It's out in the market. People are buying it like crazy. The next one is the upgraded version of that, and it requires still more research and development. And you have the money to do it, but it seems to make more logical sense from a profit-building scenario to just focus on the one that you have before. And the third one is a completely new technology that's just in its infancy and is going to be the innovative piece of the puzzle that helps society in general. Generally speaking, you're not going to focus on the one that's actually going to lose you money, and you're not going to focus on the one that requires an output of money. You're going to focus on the one that gives you an input of money. During bubble phases, that's exactly what happens. People focus on the thing that brings in the cash. Once all this sort of collapses, you end up with a scenario where instead of the money all going into one area, it's now one over here, and this cash flow is coming over here, and this cash flow from the economy is coming over there, and there's one going over here as well to another box, and they're all going to different sectors. And this tends to help fuel the rise of innovation in quite a few different ways. Usually, immediately after the bubble, the first things we start seeing happening is a push from government support into infrastructure. They will build roads, they will build train networks, they will build anything and everything. Think of 2008 and the GFC. Immediately after that, we started getting all these different railroad projects or tram projects, depending on what state you're in, or even NBN fit outs for internet usages, and whatever it may be, there's always a rollout that comes almost immediately after. And that's to try and stimulate growth. People have money in the economy, people spend the money. So that then means that the money goes into other areas. So don't be afraid of the bubble that we might find ourselves in the near term, because at the end of the day, it means that there's going to be more opportunity after at the reset cycle of it. And that's how I like to think about things. Of course, if you are looking at going down, maybe not a publicly listed path of those sort of things, and you're looking about going down, into the startups and Kickstarter style investing sort of things, bear in mind, those sort of things usually don't see a return for about 10 years. So, I tend to steer away from them so that your money's not tied up on that way. But sometimes I will. It just depends on what the circumstances are. Now, moving ahead with this RBA statement, we'll just have a quick look at all the news that's going to be on tomorrow. I'll just refresh this because I'm pretty sure this is old now. There we go. Now, tonight, not a huge amount of data out for us. We've got Euro news, which has already been. The investor confidence one is positive, which is what we're seeing tracking across the whole globe. In this case, it's significantly more positive than the forecast, which is impressive. Now, we've also got the Bank of England's Governor Bailey speaking at about 9 p.m. So I will be paying attention to that. At this stage, the discussion point is a little bit iffy, to say the least. Are we on the right date? Is today? Yep, 9th of March. Okay, so that was my last night, I'm afraid. So this one is the one we're going to be focusing on. RBA Governor Lowe speaking. And now he's going to be speaking tomorrow morning. You can see here on this little summary that comes up, they give you, the title of the speech just here, and maybe some of his questions are going to be coming in the after hours bit. Now, at this stage, we're really wanting to see what the narrative is coming from the RBA. Outside of that, we do have the employment figures and the revised GDP figures out of Europe to contend with tonight. And the small business index, I keep an eye on the NFIB, but unless you're sort of trading on the Russell 2000 and things like that, it's not all that important. Well, it is, but it isn't. It just depends on what you're looking at that evening. Industrial production figures out of Italy, not a main concern. I like looking at the German and the French ones. They generally have a little bit more that's in it for me. Trade balance figures for the EU on the German side were good as well. So, we're pretty happy on that front so far. And the NAB business confidence report I read earlier today, and the figures were actually starting to tick up a lot. So at this stage, this is why I'm focusing more on the Australian stuff tonight. We have CPI and PPI out of, or consumer price index and purchases price indexes coming out from China tomorrow. More economic data. The last couple of weeks of their data has been good. So I'm expecting to see good news on that front, which generally means for Australia, there's probably going to be an uptick in the amount of purchases that are likely going to be coming here. and of course the RBA announcement. So at this stage for the RBA, let's have a bit of a think about the Aussie dollar and go from there. Now, before I sort of start getting into the Aussie dollar as well, if you have a chart, let me know now, please. And I will do my utmost to incorporate it into tonight's piece. But I'm not sure how long we'll stick between the Aussie, and of course, I'll probably end up back on the NAS and the Dow Jones just to give us a bit of an idea on where things go. So if you're happy with me dealing with the Dow Jones and the NAS 100 at the very end as a quick recap, then feel free to not let me know. And if you do want something else, then send me a message and I can schedule that in for like the last sort of 5 minutes of tonight. Now, looking at this chart here, obviously Aussie, the one thing I always do when I look at these charts is look at the long-term side of sort of support and resistance that are likely going to be impacting price. So we can see the very first one we're going to be considering is right there. Now, whilst I can look at it there, you can also see it here. You can see it happening a little bit around here. It gives a bit of an impact around here and here. So, this 81-cent mark is a barrier and has been a long-standing barrier for the Australian currency for a very, very long time. Now, regardless of that, the next places that we're going to be looking at is on the south side down here, 68 cent. Not all that impactful. Definitely has markers for it to be useful, but not right this very second, considering where price is sitting right now. Looking at the monthly chart as well, if we were to consider these the last 3 months, this year, these three candles, they are not looking real awesome, are they? We have three very big-bodied wicks, while the bodies are getting smaller and smaller, and it really sort of suggests that whilst price can get to 80 cents. At the moment, it's getting a fair bit of pressure to be pushed down. And that fits in with the RBA narrative. They don't like our currency here in Australia being at the 80 cents to the US dollar sort of side of things. So my anticipation is that we're probably going to be seeing the RBA wanting to push back and jawbone a little bit. They're going to say the conditions are good. They're going to say that we are seeing that our economy is on track. They're going to be saying that inflation is probably a gauge of something that is quite helpful and healthy for the economy. Governor Lowe is also probably going to be talking about the purchasing of bonds and the increase in bond purchases that we saw the other week, and that is a sustainable metric number for them to be dealing with and making regular purchases to try and control the yield pricing. He's going to make a considerable mention on yields and try and calm everyone down a little bit. So, I think his speech tomorrow is going to be more psychology than it is economics, purely because he's going to be trying to calm people down about where inflation is actually heading. Now, the next places that I think are useful for us is this one here. Really, 75 to 81 cents is our range for the time being. I think that we are sitting in this period for a little bit, next couple of, at least the next month or two, perhaps, whilst it works out which direction it wants to go. And this is really going to be impactful on two different places. One, we're going to have to pay some pretty close attention to what we see on the dollar index, and just generally the value of the US dollar. Now, interestingly enough, the US dollar, if you are able to bring up a chart of the index, it's pretty easy to do, but it's increased pretty hard the last couple of days. Realistically, most of this year, I think the common bet was for the US dollar to continue devaluing with all these massive increases in stimulus happening, and particularly now with Joe Biden's package. But instead of that, we've had the secondary effect. And here in Australia, we get the secondary effect on pretty much every RBA announcement. If the RBA announces, we're going to be, increasing money supply or the M2 supply, then you end up seeing this price will generally go up when it should be going down. Now, the reason for it going down, when I say the secondary effect, it means that the first notion of it should be going down because we're increasing the money supply, that would be correct. But the second notion is that businesses are going to get advantage of having a cheaper currency, and businesses are going to get an advantage of being able to borrow for less, which means we end up with an upward tick. The same effect has actually happened in the US, particularly for tech companies and the like. In the last sort of week or two, we've seen a little bit of a pickup for a very brief moment before this week of the rotation, as I like to call it. Now, looking a little bit deeper into the pie, right here, we're in a pretty obvious downtrend in the immediate moment. It's got quite a steep angle on it. It is getting down to our 75-cent test point. I think this area gives us really two places to play with. The first test line is going to be right there, at our 75,500, with the next one at the 75,200. And then from there, we could even probably go to either this point here, 74,598, and then to 74,100. So I will mark those up, and I'll leave it there for a minute or just while I talk, so that if you guys want to put in these areas that I sort of have noticed or picked out, then this is kind of where we're looking. The further this comes down, the more likely I look at this as a scenario of price sort of trying to tick back up and check out that 81-cent range. Now, obviously, it takes time for it to get there, particularly considering we're on a daily chart. So, this would be one of those longer-term perspectives, but nonetheless, bear these in mind. On the way up, you've obviously got barriers at this point here. Now, I will change the color of these just to make them a bit easier. So you've got the long side, short side sort of things going on. These ones can be nice and pretty and pink. Now, these ones here are probably, a little bit significant. You've got, these highs that are sort of going on there. The bottom side of this is really about here. And I'm expecting that to be a difficult point on the 76-cent 500 sort of mark for us to get through if it does come down a little bit further. But right now it is testing its patience. Now, moving us a little bit further forward, the long-term thing here is we're still in an uptrend. Now, if you were to actually draw this on the much longer scale, we'll leave it on daily, I'll just squish it up a little bit. If I was to go like so, and then sort of draw one like that, it doesn't really fit anymore, does it? You could move the lines around. I don't generally like doing that. You don't want to put one where price is sitting right now. You want it to be near enough, not good enough. So, you could sit that way, but it's kind of in between two at the moment. So if you were to put a line across like that, and then to have one sitting from the bottom side up like this, it gives you a bit of a wedge. You've got an intersecting point here, which obviously is somewhere we've already bounced. But I still prefer this one. It's still been the most useful for me over the last couple of months because I've been sort of sitting it like this, and then having one on the bottom side here and using it to trade, sort of between these ranges all the way up. So if price is on the bottom side, I look for the long position and will hold my positions up. And when it gets to the top side or in the middle, I close off and wait until it comes back down again. Now, can we do that again here? Will price repeat itself? Difficult to answer, especially with the SRBA meeting tomorrow. I am wanting to really hear what he says and to sort of evaluate how they push forward. Obviously, if they go through with the idea of trying to jawbone the economy, they're going to have a very, very tough time convincing people that inflation isn't going to cause an issue. Now, even if it doesn't cause an issue, people aren't going to think that way for some time to come. They're going to want to see evidence of it before doing it. And there is so much propagation of media pushing at the moment that yields are going to continue to be wildly crazy. And they probably are. But I don't think they're going to be sustainably crazy, in the sense that, we're not going to see a yield spike to 5% tomorrow and then it's going to sit there for the next 5 years whilst jumping around rampantly. We'll be seeing areas of the market that do get that. But for the time being, we sort of have to go with what we know. Now, realistically, whilst we do, no matter which uptrend you sort of draw, even if you were to take a sort of shorter time frame focus and sort of sit on that side, you're not going to have a great time with it. Price is broken out on the bottom side. Perhaps this line will still be valid. Are we able to say it's now a change in direction on a short trend? Well, in a way, we probably can. You'd easily be able to run across the tops there like that, but it's not awesome. It's not something it's not an area I'd like. Obviously, if this current green candle was to push a little bit higher and then retreat a little bit, then yeah, okay, then at that point we can sort of say, okay, we now have a defined new trend. But at this stage, we still only have one new lower swing high to contend with, and we need at least two to sort of be able to place any lines on it. So daily charts, a little bit difficult to manage. I certainly know of plenty of analysts that are kind of just sitting on their hands at the moment. And I mean, they have good reasons to do so. The other one that you could probably sit with if you were comfortable with it being a little bit obscure is one like this, where you've got, the top, maybe not the bottom one, but certainly, this from this line to this point, gives you a pretty good area to sort of work with, especially now that price is above it again. But ultimately, there's no real great line at the moment that sort of stands out to me and makes me go, yeah, that's the one there. But I sort of wish there was, but there isn't. This is probably the closest one you're going to get. And whilst it's going to be something that you can deal with, again, it's not the one that stands out. And unless these trend lines stand out, they're not exactly, my preferred preference. Now, skipping our timeframes down to the 4 hour, this is where we start to see that there is, in fact, a downtrend starting to occur. You can easily put one like that. We've got a bit of a wedge pattern now forming if we were to use our other trend line. And now we're sort of waiting on a little bit of a bounce. The US side of this scenario is more stimulus coming, vaccines rolling out quite quickly, flights starting to reoperate, continued growth on the job side of things, week in, week out. So, both economies are doing quite well. It's now about looking to see whether they get this stimulus package of Joe Biden's all the way through, which so far, it's got one final vote, which I believe is going to be tonight, and then to see how they actually roll it out from that point. Now, I still look at 78 cent and 81 cent as our two stick points on the way up. But in between now and here, you've got these sort of areas to play with, which are, to me, not huge sort of barriers for entry. And in one, in a matter of a couple of hours, you can have price move 300 pips. So here, it wouldn't be beyond the scope of it. Dropping us down to an hourly immediate trend, we are sitting in what we would call a minor uptrend. I would be more confident drawing the line up there. And now that we are sitting so close to it up on this side, then it might not be a bad idea to look for some sort of short positions off the top of this line if you wanted to go with the counter trend trade and just trade in that shorter, smaller time frame, the 4 hour sort of time frames. 15-minute wise, nothing sort of standing out. We've kind of got a sheer cliff sort of taking off here. Unfortunately, we've kind of missed out on this one, in my eyes, at least for the time being, and we're really waiting for a reversal to get, or a retracement to get back involved in the same direction that we're sort of sitting on the shorter time frames. The shorter the time frame, the less you put in here. Might have not been a bad entry sort of place for us to look for. But on this sort of candle, this sort of action here, it's not awe-inspiring. If I'm going to get in, like if price is going up like this is right now, and I see these big wicks happening, then I get a full-bodied red candle, then realistically, I want to see one, like, an engulfing candle immediately after. I want a green candle that goes at least 50% into the body of this candle, but preferably like 150% of its previous size. And then, you can jump in and sort of try and snip a few pips out of the run up here, which would be about, 15, 16 pip on that front there. Now, I've sort of run out of time for this evening. I do apologize for the audio issues that you've had, Jason. I'm not sure what's happened on my end. I've sort of done the exact same thing I do every time, but modern technology, am I right? So if anyone does have questions or anything like that, I'm going to bring up my email address for you guys to have a bit of a look at now. My sort of contact details. Feel free to sort of get involved and be a part of it. I am quite happy to pay attention to any of the things that you guys are wanting to ask about. So send me a message either and follow me on either Twitter and Instagram, and of course LinkedIn. I'm also available, and our YouTube channel as well for any of those of you on YouTube. If you leave me a message on any one of these places, I am pretty quick to respond. And of course, I do hope that you have enjoyed tonight's session. We will be having another one Thursday this week at 7 p.m. Australian Eastern Standard Time, just like tonight. And we will be able to have a bit of a discussion, probably a little bit of a recap about what's going on with the RBA tomorrow and whatever else may be happening in the market at the time. So I do hope you've enjoyed the session. I'll let you guys all go, and I look forward to seeing you all on Thursday at the same time. Bye for now.